Today's stock is one that many investors and tech enthusiasts can't get enough of: Apple. As one of the most iconic and influential companies in the world, Apple has captivated consumers and investors alike with its innovative products and impressive financial performance. As the most valuable company in the planet, Apple turns to gold everything that touches. And right now, Apple is making bold moves, challenging the banking sector, venturing into the realm of healthcare, and preparing to launch its highly anticipated AR/VR headset. The question on everyone's mind is, will this turn Apple even more dominant? Hey dudes and duderinas, this is the Finance Dude. Welcome to one of the most complete and exhaustive stock analysis on YouTube. Since this is a new channel, you can watch how my stock picking strategy works in full detail by clicking on the videos on the top right. In this episode, we have two missions. First, assess whether Apple is a good business and has what it takes to move on to Analysis 2.0, and second, assess Apple's valuation. Now sit back, relax, and get ready for some top-notch financial analysis. I always start this first approach with the 5 dimensions method, where I base my analysis on 5 different pillars: growth, profitability, solvency, valuation, and dividends. I won't bore you with every single metric in detail, but in the end, I'll show you the full table with the ratings. First, we've got the first dimension: growth. In revenue growth, Apple has shown impressive growth over the past decade. Interestingly, every 3 years, we observe a significant surge in revenues, which coincides with the iPhone major upgrade cycles. The latest example was the introduction of 5G technology, resulting in a remarkable 33.3% revenue increase within just 1 year. However, in the last 12 months, Apple experienced a slight decline of 2.3% in revenues. This can be attributed to several factors. Firstly, the current macroeconomic environment has led to reduced consumer spending overall. Additionally, Apple currently lacks a significant upgrade for iPhones, which happens to be their main source of revenue. Based on these factors, I'm assigning a rating of 3. In net income growth, we see the same patterns of a big jump in net income every 3 years followed by a slight decrease in profits on the next year. However, on the last cycle, Apple saw a jump in profits of almost 65% to $94.6 billion. Most important, they were able to maintain this level over the past 2 years. It's crazy, they do almost $100 billion in profits each year. What a business. For net income growth, I'll also give a rating of 3. Like we saw in Microsoft analysis that you can find in the top right, the disparity between the 10-year net income growth and the 10-year EPS growth is astonishing. Apple's business profits grew by 154.7% over the past decade, while shareholders experienced a staggering 315.5% increase in profits for each share they own. That's more than double the growth. This exemplifies the power of share buybacks, which we'll explore further in the dividends dimension. For this reason, EPS growth gets a rating of 5 while net income growth gets only a rating of 3. As you can see, the same happened in free cash flow growth. However, the decrease in free cash flows over the last 12 months was much bigger than the decrease in net income. A 14.7% decrease in Apple's free cash flows. For this reason, I'll give a rating of 2. In free cash flow per share growth, you see the same relationship in net income growth and EPS growth. Free cash flows grew 102% over the last decade, but free cash flows per share grew 228.5%. Again, more than double. Astonishing. A rating of 4 for free cash flow per share growth. Moving on to the second dimension, profitability. Gross margins have been increasing over the past decade, which probably reflects Apple's growing bet on services, which generally yield higher margins compared to hardware. If that's the case, in Analysis 2.0 I'll delve deeper into segment analysis to understand the individual contributions of each segment to the company's profits and revenues. I find this growth promising, so I'll give it a rating of 3. Moving on to operating and net income margins, the growth has been relatively modest, almost negligible. Nevertheless, there has been some progress. I'll assign a rating of 2 for operating margin and a rating of 3 for net income margin. In terms of free cash flow margin, there has been a slight decline compared to the 10-year average of 23.7%. The current margin stands at 22.7%, representing a decrease of 1 percentage point. Therefore, I'll give it a rating of 1. Lastly, let's look at return on invested capital. The current level of this metric is astounding, reaching nearly 50%. Do you realize what this means, dudes? For every dollar invested in Apple's business, it generates a return of $1.50. It's truly unbelievable. In light of this exceptional performance, I'll give it a rating of 5. So far, things are looking favorable for Apple. But you know what else looks good? That like button right there. Do me a favor, smash it and show your support. Moving on to the third dimension, solvency. Beginning with the quick ratio, we observe a gradual decline over the past decade, and it is currently below 1, which, depending on the industry, is an important level of solvency. This indicates that Apple is unable to cover its current liabilities with all its current assets, excluding inventory. This isn't a big problem and it's quite normal in capital-intensive businesses. But considering this, I'll assign a rating of 2. Moving on to the debt-to-equity ratio, we see that Apple has increased its debt burden over the last 10 years. The current ratio of 1.76 means that Apple has 1.76 times more debt than equity. Despite this level does not currently raise significant concerns, it's certainly worth keeping a close eye on. Therefore, I'll give it a rating of 3. Lastly, let's examine the debt-to-free cash flow ratio. The most recent value stands at 1.25. To put it simply, this means that Apple's annual cash flows can almost fully pay off its entire debt. More precisely, Apple could repay its debt in just 1.25 years based on its cash flow generation. While the other metrics may not appear as favorable, this metric provides reassurance regarding Apple's ability to handle its growing debt. I'll give it a rating of 5. It's time to move on to the fourth dimension, valuation. Beginning with the enterprise value to sales ratio, we can observe a clear upward trend over the 10-year period, particularly since 2018. The average multiple from 2013 to 2018 was 3.3x, while the average multiple from 2018 until today stands at 7.13x, more than double. However, it's important to note that this expansion in multiples is not unique to Apple but is seen across many tech-related businesses, likely influenced by the growing balance sheet of the Federal Reserve. Considering this, I'll give a rating of 2 for this metric. Moving on to the price to free cash flow multiple, we observe a similar pattern. Valuations were in a more favorable position at the end of 2022. However, the current multiple is approaching the all-time highs witnessed in 2020 and 2021. Therefore, I'll assign another rating of 2 for this metric. Similarly, the price-to-earnings ratio follows the same trend. I'll give it a rating of 2 as well. Finally, this 5D presentation ends with the not least important fifth dimension, dividends. Apple has consistently increased its dividends for 9 consecutive years, showing an impressive 124.4% growth over the past decade. However, the dividend yield has significantly decreased due to the rise in Apple's stock price. It has declined from 2% 10 years ago to 0.5% currently. Considering this, I'll give a rating of 4 for dividend growth and a rating of 1 for dividend yield. Shifting our focus to shares outstanding, Apple has been actively buying back its shares, which is music to investors' ears. This strategy reduces the number of shares outstanding, leading to an increase in each shareholder's ownership percentage. For example, if there were originally 1,000 shares outstanding and you owned 100 shares, you would own 10% of the company. If the company buys back 200 shares, reducing the total shares outstanding to 800, your ownership would increase to 12.5%. This is why I mentioned the difference between net income growth and EPS growth in the first dimension. Apple has reduced its shares outstanding by almost 40% over the past 10 years, which is truly astonishing. Apple bought back more than 10 billion shares during that period. Wow. Based on this, I'll assign a solid rating of 5 for this metric. Now, let's consider the dividend payout ratio. While it's beautiful seeing increasing dividends, we also want to ensure they are adequately covered. Apple's current payout ratio stands at 17.1%, indicating that the company can easily cover its current dividends and future increases. Typically, we begin to raise concerns when this ratio exceeds 80%, as it may suggest a company's inability to sustain its dividend payments. Given Apple's comfortable payout ratio, I'll give it a rating of 5. Now, it's time for the summary table with every 5D component. Having concluded this 5-dimension section, we arrived at final rating of 3.23. Huge. It's thrilling analyzing businesses like this. But this isn't it. We still have lots of work ahead of us and this is just one data point in this investment process. But before we get to the juicy part where we dive into the company's valuation, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, now that you showed your love to your favorite dude, we're ready to rock and roll with this DCF valuation. First, we need to make some assumptions based on what we know from their historical data and recent trends. As such, these first assumptions will be limited, and I acknowledge that sometimes I may misjudge some assumptions due to the lack of deeper information and knowledge of the business. But that's okay because I have a backup plan, the Finance Dude's method. This method allows me to conduct additional diligence in Analysis 2.0 before making any investment decision. Before moving on to my assumptions, let's review the historical averages of my assumption variables in the Wall Street analysts' estimates. We can observe a decreasing growth trend in revenues and cash flows, with a notable 15% decrease in cash flows over the past year. However, it's important to note that, historically, Apple uses to witness these periods of decline in revenues and cash flows before a significant jump in performance. Additionally, the free cash flow margin has decreased from its 10-year average of 23.7% to a current margin of 22.7%. Furthermore, the price to free cash flow multiple is currently at its highest level compared to both its 5-year and 10-year averages. With a current multiple of 31.6x, it appears excessively high. On a positive note, Apple has been actively buying back its shares at a rate of 1.7% annually, although this represents a lower rate in recent years. In terms of analysts' estimates, they are projecting a compound annual growth rate of 3.61% for revenue and 5.23% for EPS growth over the next 3 years, which serves as a proxy for cash flow growth. These projections reflect the expected slowdown of the economy due to the Federal Reserve's hawkish policy. During such periods, consumers tend to reduce their spending, and businesses primarily focused on consumers like Apple tend to face greater challenges. However, it would be unwise to dismiss Apple's growth potential. The company has consistently demonstrated the ability to turn everything it touches into gold. Moreover, there have been rumors circulating about a new product, an AR/VR headset. On the other hand, if we consider the cyclical nature of Apple's business, the next cycle is expected to occur at the end of 2024. At present, there are no rumors regarding a major upgrade in iPhones. If you have any information on this matter, please share it with the dude in the comments section. Enough of talk, you all want to know my assumptions. I will start by explaining my thoughts regarding the base case scenario assumptions. Then, for the other scenarios, I will be either slightly more conservative or more optimistic to reflect other possible outcomes. After this, I will attribute a probability that I believe matches the corresponding scenario. Starting with cash flow's growth forecast for the first 5 years of the projection, I chose to be in line with Apple analysts' forecasts, with a 5.23% growth rate. The cash flow growth for years 5 to 10 I chose to be slightly higher at 7.0%. This is because everyone expects a world's economy contraction over the next couple of years. After that, I can see plenty of growth drivers to Apple's business that justify a revenue growth almost at the same level of the last 5 years' average. Another critical assumption is shares buyback or shares dilution. Apple has been massively buying back its shares over the last decade. Given the massive cash flow generation per year, I will consider that Apple will continue to buy back its shares at a rate of 2% each year for the next 10 years. Now let's look at Apple's free cash flow margin. Apple recently decreased from a 26.0% free cash flow margin to 22.7%. Given the growing relevance of higher margin products in Apple's business such as the services segment, I believe Apple is capable to return to those values. To finalize the base case assumptions, I need to define a price to free cash flow. Apple's current multiple as 31.6x is quite high. That's why I will choose a price to free cash flow multiple of 17.5x. Here are the remaining assumptions for the other scenarios. After running the DCF model for each scenario, I obtained the following results. Let's start with the base case scenario. If we believe that my assumptions will be met, the fair value of Apple's stock is $125.65, considering a required rate of return of 12.0%. This valuation suggests a downside of minus 27.1% from the current price. You might think that for Apple's stock to reach these levels again, it would require a catastrophic event. In fact, on January 3, 2023, Apple was trading at a 52-week low of $124.17, almost my base case price target. Perhaps the market knows what Apple's true intrinsic value is. This is why it's important to keep our analyses up to date and the levels where we feel comfortable to buy a stock. Let's move on to the bull case scenario. If we believe that the assumptions for this scenario will materialize, we could consider paying up to $189.31 for Apple stock, which represents a 9.9% upside from the current price. This implies a near doubling of cash flows and revenues, reaching $197 billion and $705 billion respectively. It's an impressive growth outlook. However, we must ask ourselves whether Apple is capable of achieving such significant growth in cash flows and revenues over the next 10 years. What do you think, dudes? Can Apple pull off this feat? Now, let's discuss the bear case. According to these assumptions, the fair value of Apple's stock would be $93.72, considering a 12% annual rate of return. This implies a significant downside of minus 45.6% from the current price, almost halving it. In this scenario, we are assuming a modest 4% compound average growth rate over the next 10 years. Although I personally believe that these assumptions are too conservative, they are plausible. Economic recession and reduced consumer spending could impact Apple's business, particularly if consumers start buying iPhones less frequently, such as every 3 years instead of annually. It's a possibility we should be aware of. Now, let's explore the extreme cases. In the extreme bull case, I made very optimistic assumptions, including a cash flow growth rate of 10.74% per year over the next 10 years, which is above the past 10-year average, an increase in margins to 30%, and a share buyback rate of 4.5%. However, I consider this scenario highly unlikely to occur. If we consider Apple's current market capitalization of $2.7 trillion, maintaining a 4.5% buyback rate would require an annual expenditure of around $125 billion. Typically, extreme scenarios like this have a very low probability of happening, ranging from 0.5% to 1%. If we believe this scenario will happen, then we could pay up to $269.79 for Apple's stock, representing a 56.6% premium above the current price. Conversely, in the extreme bear case, we are looking at a significant drawback of 69.5% from the current price. According to these assumptions, Apple's cash flows would decrease by 0.53% each year, and its valuation in 2032 would be around $1 trillion, compared to the current valuation of $2.7 trillion. It's a massive devaluation. However, nothing is impossible in investing world. We've seen how companies like IBM, which was once the fourth largest company in the world, experienced a substantial decline in stock price and importance in the global economy. It serves as a reminder that unforeseen events can have a profound impact on a company's value. Now, keep in mind that these assumptions are just a first gauge of Apple's valuation and don't incorporate qualitative information from more detailed analyses such as Analysis 2.0. Therefore, before making any investment decision, I should test and refine these assumptions. But for now, I hope this gives you a good idea of where Apple stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 24% for bull case, 15% for bear case, 0.5% for extreme bull case, and 0.5% for extreme bear case. Using these probabilities, I weighed each scenario's present value by its probability, which led me to a final price target of $136.53, representing a downside of -20.8% and indicating signs of overvaluation. As you can see from the graph, the stock is currently trading in bull case area. Ideally, we'd want to buy below the red areas shown in the graph. In fact, touch the blue area last January. What do you think? Will Apple return to the blue band? Let me know down there in the comments. We shall look further to the multiple valuation to confirm this first results. To get a fair price for a company, we gotta compare its current multiple to its 5 and 10-year averages. You can easily notice that the 10-year average has more realistic multiples, and I will consider them to calculate Apple's value. By averaging all the prices that resulted from the 10-year average of each multiple, we obtain a price per share of $110.17, which represents a nasty downside of -36.1%. This is another data point that suggests signs of overvaluation in Apple's stock. It's time to wrap up the first analysis of Apple's business by comparing the 3 different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Apple is a good business and has what it takes to move on to Analysis 2.0. Well, the 5 dimensions revealed an outstanding business, with a final rating of 3.2. Apple has great ratings across the board, only lagging in the valuation dimension, suggesting an overvalued business. On the other mission we had regarding Apple's fair value, we also saw indications of an overvalued business. Both DCF valuation and multiple valuation showed an overvalued business of at least 20%. Finally, I have the following questions to be answered in case we move forward to Analysis 2.0. What are the markets seeing in Apple to give such a valuation? How will the new Apple products that are in the pipeline perform in the future, and what will be their contribution to the cash flow generation? Is there any expected upgrade to iPhones over the next 1 or 2 years? And finally, in spite of the insane amount of free cash flow Apple generates each year, we saw a 15% decline over the last year. We all know that COVID-free money ended, but will this take a dent to Apple's profitability? All this considered, it's time for my final verdict. Apple will go to the next round, Analysis 2.0. Despite showing concerning signs of overvaluation, I have to conduct a thorough analysis of the business. I need to try to understand what the market is viewing before I make a final decision. Perhaps they are anticipating higher growth and higher margins than I am. Perhaps I'm not seeing the full picture and all the growth drivers that Apple has. If you can't wait for this second analysis, don't forget to subscribe to the channel and turn the bell on so you receive the notification once I post the video. Thanks for watching, and I'd love to hear your thoughts on Apple's business. Do you think my assumptions were reasonable, or was I too conservative? Or too optimistic? Do you have any suggestions to help me improve my analysis process? And what are the next stocks you would like to be analyzed here? Let me know everything down in the comments. Peace, dudes. You rock.